Welcome to This Explainer. Today, we're diving into a completely fascinating investment banker's audit that pretty much shatters everything we've ever been taught about safe investing. Honestly, if you have any money in the stock market, whether you're picking individual stocks or just blindly tossing a chunk of your paycheck into index funds every month, what we're about to uncover is absolutely going to change how you look at your portfolio. We are going to separate market hype from fundamental hard financial truth, and we're going to do it by leaning on an incredibly powerful framework, the 5 steps to value. Let's get right into it.
We have to start off with a massive, highly specific number, 5,636. That is the exact number of publicly traded stocks that you can buy in America today. Think about it. If you open up your brokerage app right now, that is your entire menu. Every single tech giant, every retail chain, every manufacturing plant out there, it just looks like a giant sea of opportunity, right? Well, maybe not.
Because there's actually a terrifying reality hiding behind all of those ticker symbols. See, when all 5,636 of those stocks are run through a strict, uncompromising Wall Street quality audit, literally the exact same financial audit that top bankers use to grade a business, an overwhelming 97% of these companies completely fail. 97%. Almost everything trading out there is either massively overvalued, burning a ton of cash, or just outright junk. The vast majority of the market simply does not hold up when you apply basic financial scrutiny. Now, this creates a huge paradigm shift when it comes to popular index funds. I mean, you did what everyone told you to do, right? You avoided meme stocks, you didn't gamble, and you just bought a broad market index fund like the S&P 500. You think you're buying this nice, safe diversification, but actually, you're experiencing dilution, because when you buy a massive index, you are just getting that elite 3% of winners. You're basically being forced to own hundreds of zombie companies that you would never intentionally buy if you actually looked at their books. You are paying to own the losers right alongside the winners.
Okay, so let's jump into the solution here, the 5 steps to value. Step 1, return on capital. Step 2, the moat. Step 3, cash flow. Step 4, debt survival. And step 5, valuation. This is a rapid filtering process used to separate the absolute elite stocks from all that market junk. Think of it like a laser scanner that aggressively strips away the bad businesses until only the strongest survive. Let's break down exactly how each of these 5 steps works.
All right, step 1, return on capital. This is the ultimate test of a company's efficiency. It asks a very simple question. How much real profit does a company generate for every single dollar it reinvests into itself? A great business takes $1 and, turns it into more. A bad business takes $1 and just sets it on fire. To put this in a perspective, let's take 2 massive chip makers riding the exact same AI wave right now, NVIDIA and Intel. The difference here is just staggering. NVIDIA generates 26 cents of profit in year 1 for every single dollar spent, meaning it basically pays for itself in just 4 years. Meanwhile, Intel actually destroys value with a negative 2% return. Every single time Intel spends $1, they literally go backward. It's the exact same industry, but we're looking at totally different financial realities. Let's move right along to step 2 and see how this builds. Step 2 is the moat. This filter asks a critical question. If a competitor wants to enter your market, how easily can they destroy your business? Because a high return on capital doesn't mean a thing if some new startup can just come along, copy your product next year, and steal all your customers. You need a massive, uncrossable moat to protect those margins. Consider the stark contrast we see in the digital payment space. MasterCard acts like this giant digital toll booth sitting on top of world commerce, and they boast a massive 75% gross margin. They own the global transaction rails, which makes their moat incredibly deep. But then look at PayPal. Their digital wallet edge was slowly eaten away by competitors. Apple Pay, Shop Pay, all those buy now, pay later options. That lack of a strong moat dragged PayPal's margins down to 46%, and honestly, they keep sliding. Moving on, step 3 is free cash flow. This filter ruthlessly separates internet hype from reality by demanding that real money actually comes in the front door. Because look, it absolutely does not matter how great your product looks in a commercial or how many followers you have on social media. If you're burning cash just to survive, you are running on borrowed time. And Rivian makes this crucial point perfectly, minus $1 billion. Despite building these gorgeous, heavily hyped electric cars with amazing design, they suffer a negative 45% cash flow margin and burn through up to $1 billion every single quarter. Think about that. A gorgeous product is not the same thing as a viable business. Bottom line, If real money isn't coming in the door, the business fails step 3. Okay, step 4, balance sheet survival. This filter analyzes whether a company has the debt fortress required to survive a truly catastrophic year. Because we know recessions happen, right? Supply chains break, pandemics hit. When the bad year inevitably shows up, does the company have a strong enough balance sheet to weather the storm without going completely bankrupt? Let's compare two totally different tech companies here. First, cybersecurity giant Fortinet. They earn enough profit to pay their debt interest 140 times over. If their revenue suddenly dropped by 50% tomorrow, they wouldn't even flinch. But on the flip side, you have a highly hyped stock like Snowflake, which doesn't even earn enough to cover its basic financial obligations. One bad year and a company without a debt fortress just gets wiped out entirely. Finally, we reach step 5, sanity valuation. This one is all about price realism. See, even if a company passes all the previous tests, it has high returns, a huge moat, great cash flow, and absolutely zero debt, it can still be a terrible investment if you just pay too much for it. This step questions whether you are paying for realistic earnings or if you're just paying for a fairy tale. Let's look at two really highly talked about companies. On one hand, you have App11, an AI advertising platform. It's currently trading at a reasonable 27 times earnings while boasting nearly 90% gross margins. Pretty solid. But against that, you have Tesla, trading at an astronomical 400 times earnings with just a 21% gross margin. Let me tell you, at a 400x valuation, you are pricing in absolute perfection for decades to come. So, what actually happens when we apply these exact 5 steps to value to the entire market? Well, when you forcefully push all 5,636 publicly traded companies through this rigorous, uncompromising funnel, 97% are eliminated instantly. Only 123 even make it past the basic quality checks. And at the very end of the line, only 11 elite stocks on Earth survive with a score of 80 or higher. Seriously, just 11. Now, you might expect this surviving list to just be filled entirely with hyped-up tech darlings, right? But if you look closer, beyond the obvious names like NVIDIA and App11, we actually find these unexpected, quiet cash cows. Companies like Grindr, which actually happens to be one of the highest margin dating platforms in existence. Or The Buckle, a debt-free Midwest clothing retailer that has massive free cash flow and a price-to-earnings ratio under 10. Who would have guessed? It all anchors on this one fundamental quote and realization. The market doesn't care about headlines or hype. It cares about numbers. Surviving companies aren't built on Twitter hype. They aren't built on exciting news cycles. They are built on unshakable financial foundations. The market is ultimately a weighing machine of real cash and real margins. Now, the good news is you don't need a massive Wall Street terminal or some wildly expensive data subscription to protect your portfolio from that 97% of market junk. To empower you to clean up your own portfolio, we're going to condense this massive framework into a quick, actionable 3-question kitchen table audit, something you can literally apply to any stock or index right now. First question, does this company actually make real cash today? You need to demand proof over promises here. Don't look at their glossy revenue projections for the year 2030, and definitely don't just blindly listen to a CEO's exciting promises on an earnings call. Look directly at their real margins to ensure actual cash is flowing into the business right now. If they're just burning cash, walk away. Second question, could a competitor or a new technology kill this business in 2 years? You've got to objectively test their moat. Look closely to see if their market share is truly protected from impending technological disruption. Because remember, quality filters aren't fortune tellers, right? A great company today can have its moat breached tomorrow if the industry shifts fast enough. You have to be ruthless in your evaluation here. And the third question, am I paying a realistic valuation or a lottery ticket price? Force yourself to look at the price tag logically. Your goal isn't to guess the next 100x winner by throwing money at astronomical valuations. Your goal is simply to not overpay for a stock that will inevitably crash back down to reality and take your wealth down with it. So as you look at every single stock or index fund sitting in your portfolio right now, I want to leave you with this final thought to completely challenge your strategy. Are you buying a business or are you just buying a story? Think about it. Keep focusing on those real numbers, and I'll see you in the next explainer.